Futures are pointing to a lower open this morning. The Wall Street Journal reporting that Federal Reserve officials are looking at a plan to start tapering in a few months. That would be reducing the $120 billion in securities that the Fed has been buying each and every month. Some are pushing for asset purchases to start ending by the middle of next year. Joining me now, Cornerstone Wealth Chief Investment Officer Cliff Hodge. Good morning, Cliff. Joining the conversation all morning long, Payne Capital Management President and host of Payne Points of Wealth podcast, Ryan Payne, and Spotlight Asset Management Chief Investment Officer Shanna Sissel. Good to see all of you this morning. Cliff, what do you expect? What do you think the market's reaction is going to be to at least this headline about the Federal Reserve deciding when to start pulling back on those asset purchases?
Good morning.
Morning.
We think that's the major question over the rest of the summer. Markets continue to grind higher through the dog days, but we think investors should prepare for some summertime blues, with tapering perhaps being the major catalyst. We've got Jackson Hole at the end of the month, the September FOMC meeting, which is the committee meeting mid-September. So a lot of things on the table right now.
A lot of things indeed. Ryan Payne, jump in.
Well, Cliff, I mean, just to play devil's advocate here a little bit, I mean, every economist and strategist all summer has been telling us we're going to get this correction. You know, a couple of weeks ago, we did have a big sell-off on a Monday, but it just seems the cavalry comes in and buys no matter what the news is. I just wonder, with over $4 trillion sitting in cash right now, can this market really go down?
It's a great question. There certainly has been quite a bit of participation, especially from retail. It seems to be a bit of a storming back here by the retail investor recently. But, you know, we think really the main risk is that expectations are extremely high, and investors tend to extrapolate out today's peak conditions far out into the future. Now, you look at sell-side recommendations, currently about 56% of them are buys, which is the highest level since 2002. But then you look at the data, look no further than the Michigan report out on Friday, and that was the lowest level in 10 years. So there's certainly some cross currents, but we do think the potential for a breakdown here over the next few weeks, 10 to 15%, is certainly on the table.
Well, with any bad news on the economy, Cliff, because this Wall Street Journal story points out that some are pushing to completely end the asset purchase program by the middle of next year. So that's going from $120 billion every month to zero in less than a year, potentially. An announcement expected to come in September. But with all these headwinds, including the Delta variant spiking, do you really think that the markets would react favorably if, again, this underpinning, this vast source of stimulus starts to disappear?
So that's a great question, right? And the issue is that we've got the easiest financial conditions on record. We've got valuations at nosebleed levels, right? If you look at market cap to GDP is a great example. I mean, we're at levels we've never seen before in history by two. Right. So the issue is that if and when we do begin to tighten financial conditions, there's certainly some bubbly areas in the market that are going to be harmed.
Shanna, jump in. We've got retail earnings coming up this week. Target, Macy's, Home Depot among some of the companies reporting. Shanna, what say you?
Well, I'm just curious, given the rise of the Delta variant, how much do you think that could potentially impact the back-to-school season? And how is the supply chain disruptions impacting pricing and sales, as well as supply and inventory in the retail sector right now?
Yeah, there's no question that the supply chain issues are causing a lot of problems. I mean, we're seeing that in the spiking of prices and everything from used cars to lumber. And as we know, those things are beginning to roll over a little bit. The Delta variant is really a wild card. And that's what we're seeing being sniffed out in the bond market. In my estimation, there's a little bit of the Delta variant, but also the possibility of a growth slowdown. So we're seeing that in Treasury yields, which are still down below 1.3%. We're seeing that in the yield curve, which is continuing to flatten. And then most interestingly, high yield spreads, which are the differences in rates between Treasuries and more speculative grade bonds, which have been extremely low, they're starting to widen out over the past month, which historically could foreshadow a bit of weakness. Now, I do want to be clear, we're not calling for a crash by any means. And I would advise investors, if you haven't done so, potentially take some opportunity here to raise a little cash so that you can participate when and if we do get some volatility.
Cliff, good to see you this morning. Thank you for being here. Cliff Hodge.